Hello, everyone, and welcome back to the Property Investment Australia podcast. I'm your co-host, Lachlan Vidler. I'm joined, as always, by Will Sanchez. Will, every time I kick off, I ask you how you are. I can't not do that this time. How are you, mate?
Very, very, very well. Thank you very much, sir. How are you?
How am I, mate? I'm well. It seems to be just the running updates. I'm going, but mate, filming lots of TV filming going on. Recorded another episode last week, so I was filming all of last week, which is exciting. Another home delivered. Another bit of investment expertise given by me. So another episode that you get to see me on your big screen when we towards the end of the year, mate. So just mate, super busy. Atlas team absolutely killing it. Some of the results we're getting is like insane.
Yeah.
And we're talking.
I'm glad to hear. I'm glad to hear because we've got mutual clients.
Of course, mate. We're talking like averaging typically like 20% in the first year for clients. Like it's just wild, absolutely wild. But anyway, it's out there. If people want to come and have a chat with us. 20% growth in the first year is running at a bit of an average for us at the moment. So mate, yeah, things are good on our side of the fence for sure. Well, not a bad segue into what we're going to be talking about today, I think. And what we're going to be talking about is why some investors scale and others stagnate, right? It's something that I see all too often, and I typically see it, like this isn't even meant to be a plug, right? But I typically see it like the clients that we work with are the ones that tend to scale, and the ones that we talk to who have tried to do it before us, especially by themselves, when they come to us, that's often their story is we've really struggled to kind of scale the portfolio, and we don't really know why, and we don't really know how to do it. So it's really interesting, I think, to be doing this episode today. Because for me, why some investors scale and others stagnate, even in the same market, is just the big question that so many people ask. And it's almost like a bit of that scenario of the old superannuation ads of compare the pair. Do you remember them? It's like the two people. And you don't remember them?
Not really.
When did you come?
Compare the pair. For some reason, I thought of that. What is it? Compare the market.
Yeah, let's compare them. Let's compare the market. Maybe when did you? Maybe the compare the pair ads were before you came to Australia.
I remember. I remember the catchy phrase, but I can't remember the actual ad.
Well, are you talking about compare the market?
Yeah, no, the one you mentioned.
Oh, the compare the pair. Yeah. Well, it was always just a catchy ad because it was like there's two people. And I'm sure I'm repeating it and everybody who's listening knows it, but it was just like these two people and it was an ad for like industry superannuation. Yeah. And it was just like, one goes with an industry
at the back
fund.
Of a truck.
Yeah, exactly right. One doesn't. And it's like over 20 or 30 years, your difference could be, and then it shows. Anyway, it was really interesting. But I think in property, it's absolutely true because you get into these markets, and I'm going to give a bit of a market update just to sort of kick off. You get into markets that are starting to really move, and yet you see people who are like, I just don't understand how I'm not able to continue scaling my portfolio, right? And of course, people will reach a point that they can't, but we're talking about people that should be able to that can't, right? And so I think that's what we're really going to talk about, right? So, the way that I'm seeing it is we're in a market that's absolutely turning, right? Like everybody knows there's no such thing as one property market, but if we're talking about at a macro scale, the Australian property market or state-based property markets, not just individual locations, we are definitely back towards a point in time of, markets where, a position where markets broadly are turning quite positive. And we're seeing then the interest rates are obviously starting to ease. House prices are moving up. Rental demand is so intense, right? And supply of properties is just as tight as it's ever been, right? Like it is still so tight. So it should be the perfect environment to scale, and yet some investors are and some investors aren't. So what is it that really separates them? That's what we're going to unpack today.
Well, right? I'm looking forward to that.
Exciting. All right. Well, I'll tell you what I'm seeing right now. That was a bit broad, but what I'm seeing right now, right? Things are moving hot, right? Like I'll say for Atlas, right? We're investing in very specific deals, still in some WA markets, right? It's got to be the right deal and in the right market, but there's still some investment going on there. We're doing stuff across SA, we're doing stuff across Queensland, we're doing some stuff across, some limited parts of New South Wales, and we've started doing stuff across some limited parts of Victoria, right? So we're across a very big chunk of Australia. Now, someone's probably listening going, oh, well, why aren't you in Darwin? And I'll tell everyone from the start. Darwin has the volatility of Darwin is too insane. I can tell you, my first job is to make clients money, and my second job is to make sure I don't lose clients money, right? And it's no good to do the first job, but then the second job happens, right? The problem with the Darwin property market is you may make some money now. I'm not saying that you won't, but I have zero confidence in the long-term performance history of Darwin because it's too volatile. It's got big environmental issues up there, and it's so reliant on a cyclical economy that tends to spend a lot of period in downtime compared to uptime, right? And my biggest concern is not about making money this year. I have no problems in thinking that. My problem is what happens in 3 or 4 or 5 years if it follows a pattern that it traditionally has. And I don't think there's been a huge amount of diversification in the economy up there to warrant the fact that it's not going to return to that, right? WA, right? For a long time, I was not satisfied with WA. However, WA went and diversified. There was a point in time where WA was about 69% reliant on its state-based product on mining, right? The last time I looked at it, it had shrunk down to about 49%, right? Still very high. You can see it's like WA started to diversify quite a significant amount away from what it traditionally was, which was mining, right? I'm yet to see some of the same impacts for Darwin, right? So that's sort of broadly where we're looking for Atlas and why we're not looking at Darwin. But I guess getting into those markets, right? Obviously, I'm not going to give the secret sauce away of every single place that we're investing in those areas. But the key aspects that we're seeing is that supply remains absolutely as tight as ever. Tight as ever, right? Markets are moving because there are too few properties for too many buyers, right? Doesn't matter whether you think markets have had a run or not. A lot of markets are continuing to perform and have performed for years because supply remains as, if not more, constrained than ever. And the investors, investors and owner occupiers are really starting to understand if we don't get in now, the situation isn't going to ease, right? The government is continuing to not hit their home builder targets, right? They're not going to.
Migration and what's happening with
exactly
migration.
Right. Migration. I did a podcast, I think last month or very recently, and don't quote me on this because I don't have those numbers in front of me. But on that podcast, it was something along the lines of the second highest amount of external migration, so not net migration, but external migration to Australia occurred like a month or two ago, a couple months ago. And it was the second highest, and the highest was like a year prior in April, I think it was 2024, right? So we've still got all these factors. So we have this conversation with clients a lot at the moment where they're like, oh, how do you feel about markets that may have had a bit of performance prior? And the thing is that the fundamentals in them have not changed, right? So fundamentals haven't changed. Supply is tight as ever. More and more people are realizing that that it's not going to ease off. So they're knowing that they now need to get in. They're taking active steps to do it. So there's now more competition as well. In January, we're going to see more help from the government around first home buyers, which is going to add even more fuel to the fire because the criteria is being changed. That's going to open it up to so many more people, right? So in terms of what we're seeing right now, it is a perfect storm that is continuing. It was a tornado and it's now turning into a tornado that's got flames in it, It is getting into an even more damaging scenario for people who aren't investing or taking active steps, right? That's just the truth. And for anyone who wants to fact...
People without a property, they're going to struggle if they don't take action. That's for
absolutely.
Sure.
And this is not from a vested interest of me wanting to get more clients. Obviously, I want more clients. We do a great job, This is from the point of view of if you're looking at investing and you're like, I don't want to use a buyer's agent, but I'm just holding back on investing because I for whatever reason, don't do it. Please don't do it. Please jump in. Whether you use us or a different buyer's agent or no buyer's agent or whatever it might be, please do it, because the situation is only getting worse for the people that aren't starting to hold property assets, right? Only getting worse, right? So that's I guess that's the state of the market. Would you agree with what you're seeing from your side of the fence?
Absolutely. I can see pre-approvals getting expired, having to reapply.
Yeah.
Clients taking longer to find properties. Yes, very, very weird. Very weird.
But they're
Very
not. But they're
complicated.
still actively looking, right? It's not expiring because they're being
Oh,
lazy.
absolutely.
It's expiring because it's
No,
so hard to find it, right?
it's hard. It's hard to find properties.
Yeah.
Yeah, it's very hard. Even when I try to get involved a little bit more than the normal broker, because I do help him strategize the offer, put it in writing, do this and that, set them up for success. But still, I've got one client at the moment. We've done 2 pre-approvals, but she's made, I kid you not, I think she's made, the pre-approval has only been around for like 2 weeks.
The second one.
She's already made, she's already made like 9 offers.
Has she missed out on all of them?
All of them.
And that's the thing, right? That's the thing. Like,
all of them.
That is the type of yeah. Anyway, I don't want to dwell on it too much because we've obviously got a cool episode to talk about. But I thought that it'd be a nice little state of the market for people to really understand, right? And for those of you that feel, either have access to data or feel like you're able to look at it, I challenge you to go and look at it and find a difference of opinion to me. And for those of you that don't have access to the data, especially in the way that we do, everyone knows, like we've built out our own suburb research platform that has over 500 million unique data points. And that's what we use to be in the market at the right time for our clients. If you don't have access to something like that, that's where you're definitely going to need the help, because it's going to be hard for you to formulate aggressive offers that get deals done, that don't have you overpaying, but are buying good property. It is a tough environment right now. It's a tough environment because it's so competitive, because there's so few properties and prices continue to move. And almost every time a property is sold in a lot of markets, it's almost setting a new standard at that price point. All right?
Yeah,
which is hard.
It's hard. It's hard for people who are professional investors.
Yeah.
Let alone for people who don't know much about the process.
Exactly right. Well, let's jump into the episode today, right? So we're really talking about that, why some investors scale and others stagnate even in the same market, right? So for me, I want to break down what I think are the 4 key differences between the scalers and the stagnators, okay? And for me, I think it really starts off with number 1, which is that scalers think in portfolios and stagnators think in properties, okay? So what do I mean by that? Well, the stagnators that only think in properties, they don't think about what comes next. They don't think about the big picture. They don't either think about strategy or have a strategy. All they are concerned about is what is happening today, right? And that's, truthfully, you're still doing better than so many other people in the population, right? By doing something today, right? But I don't think, if you just want to be mediocre, then I can't imagine that you'd be listening to this podcast, right? I think if you're listening to a podcast like this, it's because you want to be exceptional, right? And that's why you can't just think in properties, right? You've got to think in portfolios. You've got to think of the big picture. You've got to think about the strategy that's there, right? So those scaling investors, they think about, what is this property going to enable me to do next? I'll give you an example, right? Victorian markets, right? Not all, I'm just sort of broadly talking, right? We're starting to see some movement in Victorian markets, right? But there are definitely markets that are a lot hotter around the country with immediate upside than Victorian markets. So when we're going into certain Victorian markets for some of our clients, we're having very transparent conversations with them and saying, basically along the lines of, we're not saying you're not going to see performance in the next 6 to 12 months, right? We're not saying that. We obviously think that there will be something there. But you also need to understand that in some of these Victorian markets, this is a bit of a longer term play, right? You're going to see some of these results probably around the 18 to 24 month range. And for certain clients, if they're looking to scale aggressively and they need equity uplift absolutely immediately today, because they're not going to save another $80, $90, $100,000 for a deposit, they need that equity. Their first property, it might not make sense to be in that market, right? Even if it looks like there's a lot of upside, it might not make a lot of sense, right? But it might make a lot more sense for them to go, well, let's go to another market, right? Let's go for something that is going to still obviously have long-term performance, but you're going to get a lot of a more rapid upside today. We can then take that money. You've only got the ability to buy 2 properties right now, right? From a borrowing point of view, you can only buy 2 properties right now. So let's get your first one in that aggressive market, get that equity uplift, because you're not going to save your next deposit over that time period. And then into the next, probably 6, 9, 12 months, we can then look to pull the equity out of that property, go into the second property, and then maybe it makes sense to be in a market like maybe a Victorian market where it is going to be a little bit of a slower you don't have the borrowing to go for your third property anyway. So even if it takes 2 years to get the uplift, it doesn't matter because you don't really have an opportunity cost.
Couldn't agree more.
Yeah. What do you think about a situation like that?
Oh, right. I think you got to make the move. Otherwise, you're going to be chasing your tail. The property prices are just increasing too rapidly.
Yeah.
We cannot keep up.
Yeah.
Your income is just going to grow so much.
Yeah.
If beating inflation, right? Because sometimes it doesn't even happen, right? So you should get in as soon as you can.
Yeah, absolutely. And I think for me, like, hopefully that example to everyone demonstrates, like, this is where you've got to be thinking multiple steps ahead. And if you're not, it's gonna impact you, right? It's gonna impact you. When we talk about, if we use that compare the pair analogy for this episode, right? You're gonna like be that person. One, eh? Mate, I love it. I just think it's so easy to understand for everyone, right? Like, the point is that if you take the wrong step, yeah, cool, you're still better than a lot of people. But I don't think like I said, I don't think anybody listening to this podcast wants to just be average or slightly above mediocre, right? They want to be exceptional. They want to excel at what they're doing. For me, that's what I think about, right? Is that compare the pair. If we look 10 years in the future, if you make that wrong move and you go, for example, that Victorian property that I talked about today, and you don't get that uplift, even though you got the borrowing for a second one today, so then you can't do it. So then you got to save your way to the next deposit, and you got to wait for the equity. You might not be able to make another move for, say, 3 or 4 years. So then when we start to fast forward to the 10-year mark, maybe you were able to get 3 properties, but maybe by flipping the equation, doing it the way that I said in that story, maybe at the 10-year mark, you're actually able to be at 5 properties, right? And it still takes time to build, right? 5 properties in 10 years is still a very strong result, but you've now been able to go from 3 to 5. And that's a lot, right? Like, if you think about it, that's 66% uplift in your portfolio. And it's about having strategy and thinking in portfolios, not properties. All right. Well, then let's jump on to number 2 then, right? So number 2 of the 4 key differences between scalers and stagnators. To me, number 2 is scalers act when the fundamentals make sense, not when it feels comfortable, right? How many times have you had people come to you that sort of maybe inquire about, getting a mortgage or whatever, and then they get scared off because they hear something in the news or something like that, something that's really outside their control and is really at a big picture scale, and it doesn't they would have been a lot better off not being too concerned about that. How often does that happen?
No, it's a shame. A lot.
Yeah,
a lot. Yeah, a lot more than we want.
And I think that's a big problem, right? It's not always about it when it feels comfortable. That's where you've got to have the fundamentals, right? So if you're always waiting for the perfect time, you're never going to find it, right? Like, if you've been waiting for the perfect time, like those people in 2020 and 2021, or especially 21, and they're like, oh, property prices are moving, like it can't sustain itself. We're going to wait till they level off or they drop, right? Then we got to 22 and 23. And they're going, same thing. And it still hasn't happened. Now they've got 3 years opportunity cost. Then between 23 and 24, when rates started going up, and they're going, oh, yeah, like, well, we're going to, like, rates are going up. We're going to wait for the drop. We're going to get in. Like, we're going to make all this money. It's going to be great. And lo and behold, all the strong markets didn't drop. They actually kept skyrocketing, right? Like, they kept going up. And now we're here 2025. And those people, they've now got 4 to 5 years of opportunity cost, right? Rather than focusing on the fundamentals, like what I was talking about when I was doing that brief market update, like, the fundamentals are there. Like, this is something that really winds me up. I'm sure you can hear the passion in my voice. It really winds me up, right? People will look and they'll go, oh, that market's already performed, therefore I shouldn't invest in it. But prior performance is not a guarantee of future performance in a positive and negative sense, right? It's all about what is the underpinning fundamentals, because if they're still there, you're going to see performance. And if they're not, then you won't. It's just that normally what happens is prices go up, fundamentals change, so then it drops, or not drops, but it tapers off. But but it doesn't taper off because there was performance. It tapers off because the fundamentals changed. And it's a distinction that people don't always understand, right?
I quite like that.
You like that?
Yeah, absolutely. There's a bit of a lag sometimes when you speak.
Yeah.
Not too sure if
Oh, that's all right, mate. Well, you're still up in Brazil, so we get a little bit of that lag in there. So yeah, but for me, it's about the best time to invest was always yesterday, right? And this is, again, I always say it because I never want people to think that this is a sales pitch, right? If I'm going to sales pitch, I'll sales pitch, right? Like I do that at different times about coming to work with this, right? So it's not about the sales pitch about that. It's about the fact of
it's just the passion, mate. It's just
exactly
the passion.
right, mate. I love property. I love property. I love property, and I hate seeing people put themselves in a worse position just because they didn't take action, whatever that is, whether it impacts me or not, right? So momentum is so important, and momentum comes. You always see the people who build the biggest and the best portfolios, or not even that, the people that build the portfolios that help them to achieve their financial goals. They didn't do it when the times were good. They were consistent achievers that built momentum over time. They didn't worry about headlines or anything like that. They invested when fundamentals made sense. And for those people, often they acknowledge the fact that they weren't necessarily the ones to know when fundamentals were sound or not, and they got expert help, right? But they focused on that, not about necessarily feeling comfortable. So I think that last comment, to me, takes us right into the third one, right? The third of the 4 key differences between the scalers and stagnators, which is that scalers build a team, and stagnators try to DIY everything, right? So it comes down to support, right? Like if you're going to do a journey yourself, that means you have to do everything along with everything else that goes on in your life. And that's not, and you're doing that not as a professional, right? So the more help you have, the more efficient you're going to be and the faster you're going to be, right? And I got a good story for this, right? So I was having a chat last night with an accountant that we do a little bit of work with, right? He sent clients over to us. He's seen the phenomenal results that we've achieved for those clients, and he's now ready to go himself, right? And that client, he called me up, right? Usually, like we have a process for getting a client on board because obviously, they want to feel confident in what we do, and they see our media and results, and the fact that I'm now a national investment expert on Channel 9, all the rest, right? And it's great. It's brand building and it helps that, right? But they still obviously want to have good chats to really understand our process. I guess fortunately, this accountant has seen it executed for so many of his clients. So it sort of helps that conversation. But he calls me up and he goes, mate, I'm ready to go. I want to be aggressive. I want to probably be buying 5 or 6 properties by the end of the year, right? And I was talking him through about like what we want to do and how we can do it. And he goes, mate, like, here's the thing, right? I'm busy building my accountancy firm and we're obviously doing really well because I'm in a position to buy 5 or 6 properties, right? But I don't have the time. I'm getting you to do this because you're going to do this for me. You're going to find the properties, right? I've got my mortgage side sorted. I'm obviously doing my own accounting on it because I can do that because I'm a professional in that field. I've got another one of the boys who we know doing the legal side. So they're running that. And it means that I can then focus on doing my business, which is then going to allow me to buy more properties and set my family up even better, right? And for him, and I think that that's obviously a slightly like a bigger example, right? But
which is very relevant.
But it is. It's still so relevant to so many people because you can still take your own version of that, right? He signed on 3 properties with us straight away, right? We're buying 3 properties simultaneously for him, right? Because he's in a great position, but he understands the value of building a team and he's built that around him. So now he can continue scaling a business. He can continue growing and scaling a portfolio. He knows that ultimately at the end of the day, he's still got maximum control because he could always say no to a deal. He knows the people involved in the transaction. So as in he knows me and he knows a few of the other professionals helping. So he knows he's going to get the good advice around him. But the stagnators, if he tried to do that himself, either his business would suffer or his portfolio would suffer because you can't do it all, right? It might feel empowering at first, but imagine how exhausted this bloke could feel scaling an accountancy firm, which has got some heavy hitters that he works for, right? Like doing the accountancy and business advisory for. I'm talking like 9-figure businesses that he works for, right? Imagine trying to continue scaling that while trying to build out a 5 or 6 property portfolio by the end of the year. Like you'd be exhausted. You might feel empowered at the start, going, "I can do this," but imagine how exhausted you'd feel and the lack of results you'd probably end up achieving.
No, I was gonna say the lack of the amount of mistakes he'd be making would be huge, eh?
Yeah.
Right.
But that's the power of leveraging experts, like it's and it's the same on all fronts, whether it's about doing the mortgages, whether it's about doing your structuring and your accountancy, whether it's about doing your accounting, not accounting, your legal work, the property management, obviously the buying side. Like there are so many places to have help. And ultimately, to me, the question isn't what's the cheapest way to do that? Because what is it? You can usually have things, you got to pick two of the three. You can either have it fast, you can have it cheap, or you can have it, or is it good, right? So you can have it fast and cheap, but you're probably not going to get it good, and you can have it good and you can have it cheaper, but it's probably not going to be fast because you're going to go to the back of the pile. But if you, and it sort of, it obviously goes in that triangle. I think I've nailed the triangle. Everyone knows what I mean, or that sort of setup, right? But to me, that's the thing. It's about what's the best way to go, not the cheapest way to go, right?
Couldn't agree more. That example that you gave is actually reality of a lot of people. So people are time poor. In this, this day and age, people are time poor, and yet some who have no knowledge whatsoever, they still want to cut corners and do it themselves. Why?
Because you know what? People are always worried about, I think it's about trying to save $1,
But let me tell you, it's never been easier to explain and to sell the concept of a buyer's agent to clients than now. It's never been this easy, to be honest. In my humble opinion. Do you know why? It's very easy, man. You try to do it yourself in Sydney, all right? Just as a normal example, and I've given examples like this plenty of times. You try to do it in Sydney yourself, right? You've missed, I don't know, 5, 6, 7 times, right? Maybe 6 months down the track, you still haven't found a property. Well, now in Sydney, 6 months later, the property could very well be over 100,000, sometimes 200,000. Right. So when you look at a buyer's agent cost, is that expensive? Do you see what I'm saying?
Absolutely.
For our clients, for us, we frame it in a way that it helps them so much and so rapid that they come back very fast, because it allowed them to build their portfolio very fast, a lot faster than they would otherwise do.
Absolutely. And I like your example because there's two ways to look at it, right? On the owner-occupier front, it's you're now just paying more money for the home that you want to live in. And like, how's that really going to make you feel? And then on the investment side, you've got, well, you're now paying more money. You're now having a property that you're going to have to, that you're losing those returns on. And that's ultimately what you wanted. Like you wanted those returns and now you don't have it because you couldn't act fast enough in the right markets, the right properties, right? So to me, it's like you said, it's a no-brainer. It makes a lot of sense, a lot of sense, right? All right. So the last one, right? Number four of the 4 key differences between scalers and stagnators is scalers treat their portfolio like a business. Okay. And this is something we have talked about before, but I think it really links in well into this conversation, right? Which is that if you're really trying to do this properly, you're not going to just think about this as some side hobby. You're not going to think about this as something where, whatever happens, right? You think of it like a business. Every single decision is planned, right? Every decision has a strategy that underpins it. You have goals and targets that you're trying to reach, right? You track that performance and adapt and reinvest and move things along and make adjustments as you would in a business as things are happening, right? You've got to do the same in your portfolio, right? Of course, when your portfolio is smaller, there's less decisions to be made. But the ones that you do make are going to have more critical consequences because it's harder to scale, right? Once you get to a 20 property portfolio, it's obviously very different, right? You buy one bad property in 20 property portfolio, that's 5%, right? But you buy one bad property in a 3 property portfolio, and that's 33% of it is now not good, right? So it's got to be planned out and structured, right? I find from my point of view, the stagnators, the ones, especially the potential or prospective clients that we chat to, and often, to be fair, they don't end up working with us, right? And I find it's because they don't really have the mindset of like they are trying to actually grow and perform and they're trying to get the best results. They are looking for the cheapest option that maximizes results without realizing that like you can't really have both in that conversation is. And what I tend to find is they're very emotional and they're very reactive and emotional. And also they set to forget, right? And like your property portfolio shouldn't be something, especially at, the size that most people have. It shouldn't be something that you're living in every day. But like the stagnators are really the ones that actually set and forget. They don't have a second thought about it. They don't think about what they can do. They don't think about improvements. They just really go, whatever, it's done, it's dusted. I'm not going to think about it. And that's why they come to us 5 years later and we're going, what are you doing? Like you've had so much opportunity cost missed out because you forgot, right? You set and you forgot, right? What are your thoughts around that? You're a business owner as well. I know you own property. What's your thoughts around that mindset?
Well, I think you got to act. You definitely got to act.
Yeah.
Things change fast. I'm not too sure if you've heard this, but according to the good minds out there, every 2 years, things are becoming irrelevant every 2 years now.
In terms of what?
Well, if you get to learn new things, or now we've got ChatGPT, now we've got something else. Now we've got everything has become the pace of learning is just crazy at the moment.
Yeah, wow.
Right, and you can't just a computer, for example. You buy a computer, 2 years later, it's like it's not even working anymore because it's outdated, right?
That's a whole other conversation with the tech companies as well about making us buy more of their stuff. But I know what you're getting at, and I can absolutely see that, right? I can absolutely see that, and I think that's the point is that like the way like property doesn't change, but what changes is you got to understand the fundamentals of it, right? But what changes about how you execute on it, and like strategies and methods and approaches that might have been used a few years ago may not be usable or appropriate now, and like that's the reality. And then like your expectations have got to shift and things like that. But if you're not in it every day, it's going to be really hard to understand, and you're going to have a lot of opportunity cost that goes with that, right? Like we have a client, and like they've been on for a long time now. Like I think I've talked about them before. It was like 6 months, and the problem was they just kept chopping and changing what they wanted. And every single time there's a problem and there's something this and something that. And the problem is that they're working off their own outdated knowledge and they're not listening to advice that comes around them. And the opportunity cost is absolutely insane that's been put in front of them, all because they didn't want to listen, like it's absolute. It's like, it's what, anyway, it is what it is, right? It is what it is. But, mate, that's everything for today, right? So that's the 4 key differences between scalers and stagnators, right? Number 1, scalers think in portfolios, stagnators think in properties. Number 2, scalers act when the fundamentals make sense, not when it feels comfortable. Number 3, scalers build a team, stagnators try to DIY everything. And number 4, scalers treat their portfolio like a business. All right. So for everyone listening in, we hope that you can take something away from that. If anything, a bit of a mindset shift. Maybe take something away from my comments at the start of the episode around market updates and where things are at. And more than anything, start to take action, because one thing is for sure, running into the end of the year, it is going to be fucking crazy. All right. And I say that with the full sense of the word. It will be fucking crazy. Okay. And next year, when the government changes to first home buyer stuff comes in, it is going to be even more crazy, because it's simple maths. Right now, there are X amount of buyers and Y amount of properties. But next year, there is going to be X, times 2 buyers, but with Y amount of properties still around. Okay. So there's going to be so much more competition. And you got to remember, you wake up tomorrow, you listen to this episode, and you wake up tomorrow and you decide you're going to buy a property. You don't buy a property the next day. There's a process that goes along with that. And that can take, a couple of months to do. So action is super, super important. All right. Well, you like that? You like that, mate? All right, guys. Well, let's talk about actions. Actions are these, right? You need help on the mortgage front. You need people to look at your borrowing. You want to understand where you're at. Go and chat with Will and the team at Aussie Newtown. platinum brokers over there, which means they know what they're doing, right? His contact details are in the bio, okay? Action on our side. If you want to start, continue building, or scale the portfolio, come and talk to myself and the team at Atlas, okay? There's a reason why I'm now on Channel 9 as a property investment expert. There's a reason why I've taken over as the chair of Pippa, TV star. There's a reason why I've taken over as the chair of Pippa, because I'm so passionate about property and the industry. And there's a reason why we have the insane success that we do with our clients, of which I post our successes twice a week, every week on my LinkedIn, right? And all over my Instagram. So if you're not following, go and have a look at that. But get in touch with the team at atlaspropertygroup.com.au and drop that inquiry in. But until next time, guys, thanks for tuning in, and we can't wait to be back, and keep sending those suggestions and 5-star reviews.
This is a Piccolo podcast production.